Happy Friday out there, Team 42. It's your skipper here, Darius Dell, to present our macro minute for Friday, May 16th, 2025. Hope everyone's having a great week. So, as always, we'll start with our executive summary from today's Lit Off Morning Note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So, today's key macro question is: will tariffs lead to second round inflation impacts? Our answer: unfortunately, the answer is likely yes, but not for the reason you might assume. Instead, we view the impact of Section 232 tariffs on the housing market as the key upside risk to core PC inflation over the long term, especially when factoring in the Trump administration's likely policy mix of financial sector deregulation and a continuation of Biden's fiscal largesse. The April building permits and housing starts data suggests tariffs, border enforcement, and policy uncertainty are already curtailing supply growth in the housing market. The crash in the NAHB Home Builder Sentiment Index in May suggests this wasn't just an April/Liberation Day phenomenon either. These policy shocks are likely to have a tail. The administration's broad deregulation agenda will offset any inflationary impacts, but much like quantifying deregulation itself, calibration will be difficult. If they do not deregulate materially or fast enough, then the net impact of their policies will likely result in a positive shock to inflation, especially with an output gap of 1.6% currently and a unemployment rate that's 20 basis points below the consensus estimate of NARU. So it's going to be hard to grow without creating slack in the economy. It's going to be hard to grow in a non-inflationary manner without creating slack in the economy if you add stimulus to the economy. So getting back to the executive summary here, yesterday Fed Chair Powell doubled down on the 2% inflation target, saying without the public believing inflation would decline back to levels seen before the pandemic, it would not have been possible to achieve the recent decline in inflation without a spike in unemployment. While Powell's relative hawkishness is protecting the bond market from a faster expansion in term premia and a jump condition in market-based inflation expectations, it does put him at odds with the Trump administration, thus increasing the probability we see a Fed chair in waiting named by year-end 2025. All told, investors should expect the next Fed chair or Fed chair in waiting to revise the current 2% inflation target higher so the Fed can begin monetizing deficits at scale again. This represents a significant and underappreciated upside risk to stocks, gold, and Bitcoin, the three assets we feature in our systematic KISS portfolio construction process. Transitioning to our 42 macro dashboard, as always, a wrap up with a question from our community. This one's regarding average inflation targeting. It says, hi, Didi. First off, thanks for all you do for this community. Much appreciated. Thank you. Appreciate you guys as well. Love you guys. Says, question, why do you think Powell's comment yesterday on average inflation target is a de facto increase in the target above 2%? The current framework he referred to was designed in 2020 against the backdrop of COVID disruptions and ultra low inflation, which seemed to lean hawkish. So yes, my initial read through, and apologies for this, I was on Twitter and not actually doing my job properly. So I retweeted some stuff on Twitter about Powell's commentary, and then I looked into it further and realized that his commentary was in fact not signaling a pending increase in the Fed's inflation target, 2% inflation target. In fact, it was actually doubling down on that. So apologies for me for overreacting to the clickbait on finance Twitter, which is, again, boy, these guys are good. They even get the professional sometimes. So again, apologies for that. But again, I think it's really important to unpack this a bit because we continue to, according to our cycle inflation model, which we've refreshed every month for our clients in our macro scouting report since January of 2022, that model has consistently signaled the trend, this equilibrium rate of core PC inflation in the economy is somewhere around high twos or low threes. So let's just call it 3%. If the Fed continues to operate with a 2% inflation target in an era where fiscal largesse not only continues from the Biden administration, but actually increases when you factor in the fact that the Republican Party is currently on track to legislate the biggest debt and deficit expanding piece of legislation in history, I don't see how the Fed can continue on with a 2% inflation target in that context, because ultimately you're going to prevent the Fed from essentially, you're going to force the policy rate to remain structurally elevated, which is crowding out small to medium-sized businesses and crowding out low to medium-income consumers from accessing credit markets. But more importantly, I think the most important dynamic is the Fed, with its 2% inflation target, is unable to monetize fiscal deficits at a rate that is likely to be commensurate with the growth of the public sector balance sheet on a go-forward basis. And this is going to create all sorts of problems in the bond market from a long-term perspective. So I I think it's I don't say high probability. High probability is probably too much, but a probability. But I would say it's certainly a reasonable probability to expect that the Fed will eventually revise its 2% inflation target higher over the long term, likely once someone else is named Fed chair in waiting, because again, that will give them scope. That'll, instead of missing on their inflation target, that'll allow them to say, hey, we're actually achieving our inflation target. We can lower the policy rate on the short end of the curve, and we can start gobbling up bonds again on the long end of the curve and actually implement the dovish monetary policy that President Trump and Scott Bessent want. Ultimately, I'm not, by the way, I'm not advocating for this. I'm just saying this seems like the highest probability outcome given what the administration wants. They want a economic boom. They want a golden age. And the best way to get a golden age is to get the Fed on board. And the best way to get the Fed on board is to have the Fed, acknowledge that 2% inflation is a pipe dream. If you revise the inflation target higher to 3% inflation, that's positive for several reasons. One, I just said it'll allow them to achieve their inflation mandate, lower the policy rate. It'll allow them to flex their balance sheet again in terms of monetizing deficits, but it will also lower real interest rates in the bond market, right? If you revise your inflation target higher, what's going to happen is TIPS break evens are going to go higher as well. They're currently already above 2% across the board, no matter what market you're looking at, TIPS or inflation swap rates. But if you had a positive jump condition in inflation pricing in the bond market, what would ultimately happen is real interest rates will decline. And so you can actually further any positive economic impact from revising the inflation target higher. So in our view, it's coming. We've been banging the drum on this since January of 2022. Here it's May of 2025. I got to imagine by May of 2026, when Powell's term is over at the Fed, we will have heard more about a potential positive revision to the Fed's 2% inflation target. It may not come in May of 2026, but certainly I think by the time we're having a serious conversation about it, I think we will start to have serious conversations about it next year, if not sooner. So just be aware of that. Hopefully that's helpful. So we'll wrap it up there. Darius here presenting our macro minute for May 16th, 2025. Best of luck out there. Everyone have a wonderful weekend. We'll catch you back here on Monday. Cheers.